Is there a housing market crash in 2022? Well, if you're asking that question, you're not the only one. There's over 1.5 billion such questions in Google. I don't think it is, but more importantly, let's look at the data and make that best decision. I'm Bill Gross, the LA Probate expert, and this is my weekly real estate market update. And as a real estate broker active in the business all the time, people ask me, are we heading for a crash? There's people all depressed. There's people planning for the recession. Is that where we're headed? I can't speak to the overall recession economy. That's not really my focus. My focus is real estate. Clients who have property they have to sell or buy. Is there a crash happening there? And I don't believe the data supports that. Let's take a look at it. When you go to Google and put in housing crash 2022, you get 1.15 billion inquiries, answers to that topic in less than a second. And that tells you as a topic that people are very concerned about, and I can see why. So for example, here's Realtor.com. This is supposed to be the Realtor's own organization. June housing report, for sale home supply grows faster than ever as new seller activity rebounds. Now, is that true? And more importantly, what does that mean? Well, let's take a look at what the data shows. But before we get there, Yahoo doesn't miss a chance to say we're at a tipping point. Now, what does that mean? We're tipping as in things are getting slower. We're tipping as things are going faster. We're tipping we're at the top of the point where it's going to stay on edge. I feel like everybody's looking for a way to get you excited without telling you what's really going to happen. But let's take a look at the actual data. Existing inventory has increased significantly in the last few months. Still below the peak of where it was last year before, but more importantly, below the lowest point before 2020, which was, the greatest pandemic in my lifetime. Still less inventory than any time before the pandemic. And look how low that'd be by historical standards. Now, I do believe inventory should be lower because the economy improves and technology and things like that. But even with this dramatic increase, we're now 1.3 million homes on the market. We're still well below the lowest ever recorded before the existence of COVID. And you can imagine the economy, like a lot of things, might bounce back to normal levels, which could be twice as much as we are now before starting to slow down in terms of inventory. So I think that's really overstated. To say it's increasing is like saying airplane travel increased last year or this year again. Well, of course, you open up after COVID. That's what's going to happen. Take a look at home sales, though. Significant drop, and it's true, about a 30% drop in sales, and that's terrible. But take a look at where we are in relation to years past. Compared to 2019, we're still above many of those months. And so you have this correction happening post-COVID, or as we're coming out of COVID, maybe. We're out for the second time, whatever you want to call all that. But you have all these sales that didn't happen that resulted in extra activity, and we're trying to find and get back to a median point. The average annual change is back to zero, meaning we're kind of getting to a normal point in positioning in the marketplace. Take a look at the active listings, because if we're going to talk about excess inventory, you can see that 2022 is slightly more for the first time than 2021. This is the current active listings in the metro areas, but well below 2019 and 2020. So other than the time of the greatest pandemic in my lifetime, and I do mean to emphasize that, the active listings are still historically low. Even with this huge run-up, it's low by historic standards. Now, take a difference year over year. Yes, it's increasing compared to the prior year. Why is that? Because last year we were still in the full throes of the pandemic, perhaps, and now maybe we're coming out in many market areas, but we're still way below all prior years and only slightly above last year. These numbers are on a national basis. And notice, though, the price has gone up. Now, it's true that I think the price is leveling off this past month, but look what's done up in the last couple of years and continuously since 2010. So even dropped a bit, it might be a correction from all these years of run-up. Now, these are national statistics. Let's go and take a look at California. California overall, here's the headline number from the California Association of Realtors, that sales are down 8.4%. The median price was down 4%, but year over year was up 5.4%. And year to date, sales were down about 11% through June. So sales are slowing down in our state. But take a look at the data, and here's something that jumps off the page to me at least. When you look at the price year to date, appreciation in most areas, right? Take a look at, for example, Los Angeles metro area has the worst month most recently, or one of the worst months, because it's a big part of the market. But year over year, it's still up 8.5%. But when you go up into Northern California, San Francisco is down 2.6%. San Mateo down 0.5%. So these two areas, big market areas, by the way, high price market areas, are going to take down a lot of the overall statistics. So it's true, I think, in those areas, you're seeing tremendous declines in tough markets. And in other markets, you're doing pretty well. It's a bit of a mixed market nationally. Now let's take a look locally and see what the market looks like here in the multiple listing service that I'm a member of here in Southern California. Homes for sale up dramatically, finally passed last year in the range of the year before. But compared to prior years, it would be a historic low compared to the pre-pandemic period. The homes for sale still dramatically below the year for period. Now, sales are down from where they were 30%, but are still in the range of prior years. New listings not rising up as quickly, not as much inventory. We know that. So what's happened is with the prices slowing down, the sales slowing down, sellers are not coming in the market as quickly. And then if you take a look at sold dollars per square foot, it's coming down. On the high end is driving that. The high end houses are coming down, but it's still above every other year prior. And so we're seeing some of that pandemic period panic changing, some of that pandemic period being given back. Like the stock market, we had a huge run up in Bitcoin to whatever it was, 60,000 or 50,000. And that's settled down to 22,000 or so. But still, it's a fantastic number if you bought Bitcoin 5 years ago, 10 years ago. So what does Zillow say? So they're predicting housing increases for the next year of 7.8% nationally. That's average overall. So here's the problem. If you have a 9% inflation rate and a 7.8% home appreciation, you're giving up a little bit of ground, or you're keeping up almost with inflation. But keep in mind, most people, they only put into the house 20%, 30%, maybe 5% down. And so if the house overall is going up at 7.8%, their money is being multiplied by that factor. And so that's why real estate is such a great hedge against inflation. You leverage your money, there's tax advantages, and still, even in a recession facing, predictions are housing values are going to go up. So overall, what do I see? I see corrections. The rate increases, the mortgage have stopped. We briefly pierced 6%. We're now back down to about 5.6% mortgage rates. But that run up in rates has caused a drop down in sales. Drop down in sales has caused a little bit of increase in inventory, not a dramatic drop. Sellers are moving out of the market. We're looking to have a market price for the next year about inflation or a little bit less. Great time to own real estate. And if it's a great time for you to buy or a great time for you to sell, you should do that. The last thing, I always find these articles with ridiculous headlines. Here's the National Mortgage News. Mortgage default rises to highs not seen since the fall of 2020. So what they're saying is, since the great global pandemic, and this I think was before the government made the changes to give people relief on the mortgages, mortgage defaults had risen quite a bit. And we're now back below that number. It sounds a lot worse than it is, but in reality, that number is meaningless. The overall number of delinquencies is very low by historic standards. When you see the actual percentages, they have to go back to the pandemic period, but you can see before that we had much higher delinquency rates in our marketplace. So what does all this mean? So again, I have a crystal ball, actually. It's right there next to my subscribe sign. I have a crystal ball. It doesn't tell you where the market's headed. But you look at the data, and right now, there's not enough houses in the market for a crash. There are too many buyers coming into the market for a crash. The mortgage rates, which seemed a few months ago to be on a never-ending spiral increase, seems to have slowed down and hit a range of about 5.5% to 6% for now. And based on that information, we now have a fairly normal market with good appreciation. 7-8% is fantastic, and plenty of opportunities for buyers who are serious to get the property they want. So if I can help you, call me, text me, email me. I'm Bill Gross. As always, make today your best day ever. Thanks so much.